All right, guys, it's 12 o'clock. Is it time we get started?
Of course.
Fantastic. I want to thank everyone for joining us today. This is the last part in our Business 101 webinars, and today we'll be going over my specialty, taxes. Nick will be helping me bringing in some questions. I'll be kind of bouncing some ideas off of him, and he'll be running the slides. And then Catherine is here to assist you in case you have a question. Feel free to use that chat function. We'll be happy to answer those to the best of our ability along the way. And if something requires a deeper conversation, we can always schedule an appointment after the fact. Nick, let's take it away. So go back one slide, Nick. So one thing I did want to take a chance to introduce is our holistic business tax team, which we don't normally go over in these webinars, but we need to start to because Nick and I are not the only ones on the team, nor is Catherine. So we have a whole variety of people here. We have a whole bookkeeping team, as you can see. We've got Elisa, Jennifer, Nick. We've also got Crystal involved with taxes along with Jake. Nick works on bookkeeping. And then we've got Catherine, our CSC. We've also got Maria and Nancy on our bookkeeping team. And then Bill is our CFO services guy. He's the one where if you're wanting to kind of explode the way that you do business, he's a good resource to change your way of thinking and bring it along those lines. All right, Nick, let's talk about what the main topics are today. So we're going to be going over how is your business taxed. I think that's a big point of confusion with people starting new businesses, talking about what you can deduct as a business owner. And then that question that tends to pop up at the end of the year that people don't really want, which is, why do I owe money? So Nick, let's take it away. So there's lots of different type of taxes in a business. Typically what people think of in regards to their business whenever they're having conversations with us are income taxes, but there's also a variety of different types. So I think we should hit them all because a lot of these webinars are designed for those new business owners. So the first type is an income tax, which is as a business earns money, either the owner or the business itself is going to owe money to the IRS or to the state governments and pay income taxes on that income earned, just like you do as an individual. Another type of tax that you're going to come across, depending on your type of business, is a sales tax. So for anyone that's joined us in the last 3 webinars, we love to talk about a jam company. So if I'm selling grape jelly throughout the year, for every jar of jelly that I sell, I'm going to impose a sales tax that I will then pass on to the customer. It will be X percentage, just kind of depending on where I live. There's different sales tax rules for every state. Every location has a different sales tax rate. So if you're starting a new business, I highly recommend you have a conversation with your accountant. Talk about if I owe sales tax, and then also how do I pay it? How often do I pay it? And Catherine, it looks like you may have a question or a comment.
I do have a question. How do you know if you owe sales tax or not? Like what businesses have to owe sales tax?
It depends. So normally businesses that sell products are what's going to traditionally owe sales tax, but as Nick knows, there's often service style businesses that also have sales tax. So that includes gyms in the state of Missouri, for example. Nick, are there any other kind of oddities that are outliers that I'm not thinking of with outside of gyms?
Yeah, the big ones, the gym, other ones, of course, auto dealerships, that's one that seems to be forgotten about. I also want to add on part of the sales tax piece is use tax. Here in Missouri, we have a use tax. So anything like that you purchase out of state that you're selling back to your customers, there's a separate tax filing that you'll have to keep in mind as well.
Yeah. So, for example, if your use tax can be used if you're actually using materials that you haven't paid sales tax and finishing a product with that. So think of kind of those construction style businesses. Sales tax is fairly complex. Yeah, I think it's oftentimes overlooked in terms of its importance. So absolutely, you need to just talk to your accountant, your CPA about what your business is and see if you're going to be assessed sales tax, excuse me. It can even be, it's not necessarily a quote unquote sales tax, but states like Hawaii and Washington will even have a sales style tax on rentals. So it's hard to say that there's a hard and fast rule across the board, across the country, because there simply isn't.
What is your recommendation? So if you're starting a new business and you don't know like what kind of taxes you're gonna owe, if you're gonna owe sales tax or use tax, is the best thing to go to your CPA? Like, what do you recommend to figure that out on the front side?
Yep. So everyone's different. Let me start off by saying that some people love to do research and they may want to find out themselves. If you're not that type of person, yep, just give us a call and let's talk about it. I think that's the best solution. I don't recommend a novice steps into this and immediately pours themselves into sales tax research. That just seems like an unnecessary headache when it's something that an accountant could probably answer fairly straightforward for you. Some different types of taxes moving forward are property and real estate taxes. So property is not necessarily unique to the state of Missouri, but the state of Missouri will assess you a tax on personal property that you own. So if your business has a car or you bought a bunch of equipment, the state of Missouri will assess you yearly a property tax on the value of that equipment. As that property depreciates in value, the tax goes down over time. It's something that we certainly do here at Hawk Cruising Associates. It's not something that we do for everyone. It's not something you have to have a CPA prepare for you. But a lot of people like to hand it off because they'd rather focus on their businesses. And then real estate taxes are something that are pretty straightforward, assessed by your county. So the city of St. Louis, if you own a building in the city of St. Louis because you're selling jam out of it, you will pay real estate taxes on the value of that property. Those real estate tax rates depend on county, but the payment process and all that is kind of straightforward and pretty standardized across the country. There's not a whole lot of differentiation or help required on our customers' part, in my experience, where we're having to help them pay real estate taxes. Nick, have you come across anything like that?
No, I am not.
Yeah. And then the last sort of tax thing that people should be thinking about, it's not necessarily an income tax imposed on you or any type of tax imposed on you, but whenever you're thinking about these sales taxes and property taxes and income taxes, you're oftentimes thinking about, I have a filing requirement. And another filing requirement you're going to come across as a business are 1099s. So if Nick and I have our jam company and we're paying Catherine as an outside consultant because she actually knows how to make jam, which she does, fun fact, we would pay her. And if we paid her over $600 a year, we would be required to issue her a 1099 for her services. That's an IRS requirement. It's not this is a best practices type of thing. It is what you should do. And there are penalties and fines that are assessed on you if you fail to do it. But the process for gathering the information and submitting them is, I will say it can be cumbersome, and Nick can probably speak on this more. But I think if you do your due diligence along the way, it makes the whole process at the end of the year a little bit easier. Nick, do you mind talking to kind of what you recommend people do as they go along so that when it comes time to file these forms, it's a fairly straightforward process?
Yeah, definitely. The first thing to think of on deciding if you need to file a 1099 for somebody is what kind of services are they providing. So like Jordan mentioned, it has to be a service. If Catherine sells us supplies to make our jam, she's giving us a good. That does not require us to file a 1099. So it has to kind of fall under that consultant umbrella. But best practice would be to send a federal W-9 to the person that you're doing business with and have them fill that out. That's going to provide their name or their legal entity name if they're under an LLC or their own business of whatever kind. And they're going to provide their tax ID. So that could be their social security number or the federal EIN if they are operating under a business. And it's just there for them to verify that they are a taxpayer. So when it comes to at the end of the year, you can go through your accounting records, pull the number that you paid them throughout the year, then file that 1099 based off what they gave you on that W-9.
Yeah, and I would say go ahead, Catherine.
Oh, I was just going to say, like, how do different bookkeeping softwares track that information? Because I know you can do it definitely through Xero and QuickBooks. Like, is there a way to store it, Nick, so that you don't have to kind of reinvent the wheel every year?
Yeah, so in QuickBooks and Xero, there's a 1099 function in there that we utilize. I would definitely encourage that, and it will kind of save all those 1099 vendors that you have and can prepare a quick report at the end of the year with the total balances that you've paid them throughout the year.
And I would say something that's almost unique to 1099s is there's a lot of things that you can do or not do throughout the year that HKA can come in at the end and help you or fix something. If you don't have any of this information, our hands are kind of tied. We can't just make up a 1099, and we're not private investigators or anything like that. So it is important that you keep track of that as you go. Nick, Catherine, anything else before we move on?
No.
Fantastic. So let's talk a little bit about how a company or a business is taxed, because it's a little bit different everywhere. So a lot of people think that their businesses themselves pay income taxes. And for a majority of people, that's just not the case. Public companies, C corporations, they do. I'll tell you that those are pretty few and far between. Normally, if you're into a C corporation, you're going to be in a business that's designed to sell or designed to take on different styles of investors or designed to go public. If you're thinking of your typical small business, you're going to be thinking of these different ones, these S corporations, partnerships, and single member LLCs. For all three of those other ones, the income is reported on a separate tax, or for two out of the three, the income is reported on a separate tax return, and it then flows through into the owner's 1040, which is your personal return. So it doesn't traditionally pay taxes at the company level. There's some exceptions for non-resident partners in certain states, or Illinois, for example, has a tax that is essentially a personal property tax assessed on businesses. So it's not necessarily income taxes that you're paying at a federal IRS level, which is normally the material level. There may be some smaller state taxes that come into play, but in general, the easiest way to think about this is S corporations and partnerships file separate tax returns. They give K-1s to the owners, which is a statement showing how much money they made, and then that owner then pays the taxes for the earnings of that company. Single member LLCs just skip two of those steps. You just simply report the income on your personal tax return for your business, and then you pay the taxes on behalf of yourself. I'll go into how C corporations are taxed just so that I can make sure that we cover it, even though it doesn't necessarily apply to a lot of clients. There may be a potential C corp starter on the thing right now. So a C corporation pays its own separate income tax, and then as money is left over, so let's say Nick and I started Smuckers Incorporated, and all of a sudden our company has made $500,000. We've paid ourselves a living wage, and we've paid off all of our expenses for the year, and we've got $200,000 left over. Well, we're going to want to leave some money behind because we'll have to buy supplies for operations. So let's say we're going to take $150,000 of that leftover earnings, and we're going to pay ourselves in what's called a dividend for a C corporation, which is just a word for saying I'm going to pay myself money that's left over from the profits. Nick and I will pay income taxes on that dividend. So the company itself has paid taxes on all of its profits, and then any money that's distributed to these C corporation owners, they also have a secondary tax. That's why C corporations fall out of favor for the general public, because of that double taxation rule. You know, C corporations, if you include that tax rate along with the taxes you pay on your dividend income, overall, you're going to pay more taxes on C corporation earnings. That's why a lot of people don't have them. Cash versus accrual. I would say a majority of people are going to be cash basis taxpayers. Nick and I have kind of covered the difference between cash versus accrual accounting, but Catherine, you're popping on. I have a feeling you have a question.
Oh, no, I was hoping that you would explain the difference for someone who doesn't know where to start with something like that. Maybe it's their first time on the webinar.
In selecting an entity, or cash versus accrual?
Cash versus accrual.
Sure. Cash versus accrual, I would say, is something that your CPA should recommend to you. You're always going to keep your financials, or most people will keep their financials in an accrual fashion. So that basically means if I have outstanding expenses at the end of the year that I haven't necessarily been billed for. So let's say, for example, Nick and I are having Catherine on as a consultant for our GM company. And I know that Catherine has provided us with 10 hours of service and she charges us $1,000 an hour because she's a great GM consultant. And I know that we're going to owe her $10,000. She has not sent me an invoice yet. I haven't written a check yet, anything like that. But I still know that I have incurred an expense. I would record that expense on my books as an accounts payable, which is just saying an IOU to Catherine of $10,000. If I was a cash basis taxpayer or a cash basis bookkeeper, I wouldn't worry about it until Catherine sent me the bill. In terms of selecting cash versus accrual for a tax paying basis, a very simple way to think about it is if I don't have a lot of receivables, but I have a lot of payables, it's probably going to be more beneficial for me to be an accrual basis taxpayer because I'll get the benefit of those expenses, which is reducing my taxable income versus cash basis. I would not get to write those off until I actually paid them. So once again, it's a matter of preference. I will say that a feeling is oftentimes just as important to the math as people. So some people just like the idea of paying as cash goes out, but it's a conversation to have with your CPA, absolutely. Yes.
Can you change, like, let's say I do cash 1 year, but decide it's not my thing? Like, can I just change over when I want to, or how does that work?
That's a very good question. You can change. You can't flip back and forth, though. So it's supposed to be a permanent or a very decisive change whenever you change your accounting method. I don't know what the actual rules are in terms of there's a minimum period, anything like that, but it's not something you can continue to flip back and forth to your benefit. Good question. And then lastly, the biggest question that I get all the time is, I made money as a company and it's sitting in my business checking account. What should I do with it? What happens if I don't take it out? Do I get taxed on it twice? Nick, do I get taxed on it twice?
No.
That's correct. You do not. So whether you take the money out, leave it in, there can be some exceptions. I'm not going to get into basis during this conversation, but general rule of thumb, if the company makes money and you want to leave it in the company, you can leave it in the company. Company makes money, you want to take it out, you can take it out. There are no tax consequences so long as you're an S corporation, a partnership, or a single member LLC. C corporations, once again, very rare that people even set these up. That's a different story. Any other questions before the next slide?
We don't have one right now, but just a reminder that if you do have one, you can send me a chat or you can click on the question and answer button and I'll make sure they get answered. Thank you.
What can I deduct? The second most common question I get, I'm sure. Before I get into all these different things, if you are a new business owner and you want to know what you can write off, there's a couple pretty simple things you can do to help yourself out a lot. Just go online and print off a Schedule C. That'll tell you kind of the basics of expenses. It'll show you can have advertising, auto, salaries, things like that. The second thing you should do is ask yourself, is what I'm spending my money on ordinary, necessary in the course of business? If we have a jam making company and we want to buy jars, that would be an ordinary, necessary expense in my opinion, and in the opinion of the IRS. So yes, you can absolutely deduct that. If we have a jam making business and I want to buy a horse because I like them, it doesn't necessarily make sense for a jam making business. So could you write it off? Yes. Should you? No. Will the IRS take away that horse deduction? Yes. So just those common sense questions are normally at the end of the day the correct answer. If you're unsure still, it doesn't have to be your tax person that helps you. Nick would be able to help you in terms of what's a deductible expense or not, just because Nick specifically works in everyday deductions for businesses. So he's able to tell you if something you're doing is reasonable versus unreasonable. Vehicles is one of the oftentimes overlooked deductions. So Heavier vehicles you can kind of think of in your mind tend to be able to be written off more quickly. Once again, is it ordinary and necessary in the course of my business? If I'm delivering jars of jam throughout St. Louis County from my jam making business and I have a van, that's absolutely ordinary and necessary. If Nick and I have our operations in St. Louis County and I live in St. Louis City, and all I do is drive to that brick and mortar location and then drive home at the end of the day, it's not really necessary for the business to have a vehicle. It's just my personal vehicle that I'm taking to work. I'm not going to be able to write that off. And I would say that's oftentimes one of the more abused write-offs over the course of business is commuting mileage is not considered business mileage according to the IRS. There's some things that you can do to make it to where it can become no longer commuting mileage, but instead business mileage. That includes if I saw Catherine along the way home, if I stopped by my consultant's house, we talked about jam, and then I drove home, that mileage then becomes business mileage. But really, whenever you think about business use vehicles, they should be used in the course of your business, not getting to and from your business. Charity versus advertising. Go ahead.
Sorry, quick question. So what kind of expenses should someone be tracking if they are able to deduct auto expenses?
That's a good question. Track your mileage is the biggest thing. So track the amount of business mileage you have versus commuting mileage versus total mileage. That is your best thing to do. You can back into a lot of expenses that way. Other than that, just think about what do you spend money on for your car? Repairs, oil, gas, air fresheners. Why not? Just anything related to your car, really. I think that air fresheners would qualify, Nick. It would be ordinary and necessary in a vehicle I used.
What about car washes?
Absolutely. If we have a van that we deliver our jam in, I don't want it to look bad whenever I pull up to a potential client. So washing that van is absolutely a reasonable expense.
Could you explain total mileage really fast? That's a question that, as a missing items person, I get that question a lot. Like, what is total mileage?
Sure. The easiest way for someone to find out what their total mileage is write down the mileage as of the end of, or at the very beginning of the year. So the first time you step into the vehicle, January 1st, write it down at the end of the year. One minus the other is the total mileage. Total miles that you have driven that vehicle throughout the year for any sort of use is what total mileage is.
Why do you need that total?
That is another good question. Because that's what determines my business use percentage. So if I can specifically identify that I've driven 4,000 miles for business, and I know that my car has a total of 6,000 miles, that means that I've used my car 2/3 for business, 66%. There's a threshold with writing off vehicles where under 50% you're not allowed to use accelerated methods. So it is important to know that percentage of business use. One common kind of workaround people will try to do a lot of times is they'll buy that vehicle on, December 30th. They'll make one business trip with it. They'll be able to write off a good portion of it. And that's perfectly fine and allowed. So long as you're going to continue to use that business for more than 50% business usage, that is a workable strategy. If the next year it's going to go to 5, you're just going to recapture all of that write-off that you've had and you'll just declare income again, essentially. Any other vehicle questions? Those are good questions.
It doesn't look like we have any more at this time.
Fantastic. Categorizing charity versus advertising. So the kind of that gray area where it could be one or the other is maybe sponsoring a golf tournament, something along those lines. Advertising is always going to be a deductible expense. Charity can be dependent on the owner. So for example, in our GM business, I don't currently itemize my taxes. So having a charitable write-off won't necessarily benefit me. So it may be better to consider those expenses advertising. So just something to think about as you're recording your expenses. It's never going to be a huge win versus a huge loss. It's just going to be kind of something small you can do to help yourself sometimes. Nick, do you mind explaining to me the difference between a meals expense versus entertainment expense and why the difference matters?
Yeah, so a meals would be something if Jordan and I are working together on this gym and we take out a potential client for lunch, or we're going to lunch with Catherine. That's we're talking business. We're everything is centered around business. So that's fair. So entertainment is kind of on the flip side, where we're going out and doing something like a company function. We're hosting an event for our employees, for example. HKA has done that in the past. They're a great time. That's really the two biggest differences, I'd say.
Yeah. Just think of what is the primary function. If my primary function is I'm going there to eat, think meals, absolutely. Let's talk a little bit about business use of home. What is it?
Sorry, Jordan, why does it matter? Like, why does classifying something as meals versus entertainment matter?
That is another good question. There were some tax law changes over the last couple of years to where entertainment expenses are no longer deductible. The IRS argument for not allowing deduction is too much personal enjoyment behind them. So I have too much fun whenever I go to a Cardinals game, and it's not allowed as a deduction. That was the terminology my tax professor in college always used. I guess I don't know that's the official IRS terminology, but I'm going to go with it. And then meals are typically a 50% deduction. There was some provisions for the last year to where you could actually write them off 100%. That was because they wanted to encourage people to go to restaurants. So meals from restaurants for 2021 are 100% deductible. Anything else on that? Fantastic. Business use of home. So if I'm operating this business, how do I operate? Yes.
Sorry, we just got a question in. Are meals for 2022 going to be deductible? Do we know that yet?
They will be deductible. I can't recall if 2022 meals are 100% deductible or not, but that is a great question. And whoever asked that, I'm happy to get back to them after the meeting.
Perfect. Yeah, I will. We'll get back in contact with you. Thank you.
Thank you. Good question. Let's talk a little bit about business use of home. What is it? Why does it matter? Business use of home is, think Nick and I are running the jam business out of, we'll use Nick's house because his would be more suited to operating the business out of versus mine. But let's say he's got square footage of 1,500 square feet for his house, and 500 square feet of that is where we make and sell our jam. I am allowed a deduction, or Nick is allowed a deduction for using a portion of his house for business purposes. So there's a couple different methods. There's a simplified method, which is just $5 per square foot of your business usage home. You get to write that off, maximum 500 square feet, so total $2,500. There's a complex method where you can use 500 over 1,500, that fraction over your total home expenses. Think your utilities, any major repairs, cutting your lawn, having someone cut your lawn, things along those lines. You can write off that portion of it as a business use of home. Why we encourage people to do the simplified method, oftentimes it's just as beneficial and it's less work. You don't have to find every single bill you paid for your house over the course of the year. And why people maybe need to be careful about it is it was something that was abused in the past. And it's on the IRS watch list. So if you have a business use of home, it doesn't mean you're going to be audited. It means that if you're writing off a large portion of your personal life through a company, the IRS is not going to allow that. And they'll either eliminate that deduction for you or just reverse a piece of it. Let's talk a little bit about depreciation, just because it's, I think, something very foreign to people who are not intimately involved with accounting. Depreciation is, I buy a fixed asset. So if I buy a jam capper for my jam making business and I want to write it off over a period of time, that jam maker, it's not worthless in the first year. So the IRS has a procedure where they'll have you write it off over a course of multiple years. So that jam capper is a machine and it has a normal useful life over 5 years. So I'm going to write off that expense over the course of 5 years rather than the first year. You can write it off all in the first year with bonus depreciation under the current tax law. May not be the best thing to do for you. there's some strategies behind that. So let's say Nick and I just started our jam making business this year, and we don't make a whole lot of money. We bought that jam capper, and it was expensive. I could certainly write off the entirety of that asset in the first year. Nick and I will probably have a small loss on our tax returns, and we won't pay any taxes. But let's say that over the next 5 years, the GM business takes off thanks to some good consulting from Catherine, and we're all in the highest tax brackets. Well, we've wasted that write-off in the lower tax brackets versus writing it off against the higher tax brackets over the course of 5 years. So yeah, we don't get that initial bite at that apple, but we get more over time because we spread it out over a higher tax rate. Why does depreciation exist? Because it's what accurately reflects the useful life of an asset. That's the plain and simple answer. Is something that is put in place is going to be put in place over a course of years versus being used up in the current period. So that's why it's written off over the course of years. Yes, Catherine.
Is it always 5 years?
No, it is not. There are different depreciable lives for all sorts of different assets. So a lot of, your furniture and equipment, think 5 and 7 year. Normally think if something's got some sort of computer type chip in it or some sort of electronic device in it, oftentimes it's 5 year. Furniture is going to be 7 years. Leasehold improvements are 15 years. And then let's say we have that building that we purchased in the city of St. Louis. We're going to write that off over the course of 39 years as commercial property. Anything else on depreciation before we move on to R&D credits?
I don't have any other questions right now.
The reason I wanted to put R&D credits on this slide is to notify people that they exist, for one, because it can be free money essentially. And Nick has actually been intimately involved in helping clients with these R&D tax credits. Nick, why don't you just kind of speak to what they are and maybe who should be thinking about whether or not they qualify?
Yeah, so the research and development credit is designed to allow innovative ideas, development of new technologies, and just promote taxpayers to come up with really new, cool things, basically. So in our jam making business, if Jordan and I decide, did you say a jam capper or bottle capper? Is that what you use?
Yep.
So if we invent this new piece of technology that caps the bottles more efficiently, it's better for the jam and better for our customers, that could potentially qualify for the research and development credit. There are specific requirements to meet the credit. One thing is it has to be a new and improved business component. I would argue that this new invention that allows capping the bottles more efficiently, cost savings, and better for the jam is an improved component. And there has to be some level of experimentation or development. So that basically means you can't go into the project already knowing what the result is. You have to spend some time on developing a product or an idea. That's the big thing. Jordan, any questions on kind of where I'm going with this?
I don't think so. I just want people to know it exists. There are companies out there that will do it for you, and it is free money potentially. So we try to identify for our clients when we think they'll be eligible for R&D tax credits. And it's certainly just worth the client knowing that they are out there.
Yeah, and what goes into that, the credit ultimately is, so during our research and development on this new piece of technology, so anything we've spent towards any of our employees working directly on the new piece of technology, or anything that I outsource, I get a certain percentage of that back. It's all percentages at the end of the day on what the credit will ultimately boil down to. And I know Jordan mentioned earlier in the slide that the IRS kind of has this top 5 watch list, and starting in 2022, the R&D credit is on that list. So if you're not entirely sure if your business qualifies, let us know. The IRS are asking to submit some pretty significant due diligence along with the tax return to support. In the past, you could just submit your tax return with the credit worksheet. Now they actually want the backup for that.
Which honestly is surprising that they just started doing that. But yeah, absolutely. Catherine, anything else on this slide before we move on?
It doesn't look like we have any questions at this time.
Fantastic. One of the most common questions that I come across, unfortunately, is, why do I owe money? I didn't come home with any more cash in the year than I started with, so how is it possible that I could owe money to the IRS? There's a couple different things that are normally the main offenders for that. So fixed asset purchases is one of the first ones. So once again, think, what if we decided to depreciate that jam capper over the course of years because it's going to be more beneficial to us in the future? We're only writing off a piece of that, but we already spent all the money on it if we financed it with cash. So it's very possible that we ended up with less cash than we started, but at the end of the day, we still had taxable income. Think loan payments as well. So loan payments are not deductible except for the interest on those loans. So if we really heavily financed our company with debt because we didn't have a lot of starting capital, it's very possible that a lot of our money is going to go towards loan payments, and we won't end up with more than we started, but we still have taxable income. It's a fairly common scenario. So it's also one that I think just stings a little bit because you're not taking anything home for yourself, but you're still paying more money to the IRS, which I can certainly sympathize with. Partner and shareholder distribution. So once again, another scenario where we're going to have some taxable income, even though we don't have as much cash in the company. As what if over the course of the year, Nick and I took out basically all the money that the company was generating? Well, our company's not going to end up with more cash, but once again, our taxable income is based off of the earnings of the company, and those distributions are not a deductible expense. So it's very possible that over the course of the year, we've taken out all the money of the company, but we still have taxable income, which we'll pay ourselves, which is fine because we've got all that cash still, hopefully. Hopefully Nick hasn't blown it on some sort of car. Cash versus accrual account. Go ahead, Catherine.
Could you, and maybe you were going to talk about this somewhere else, or maybe you already have, could you talk about self-employment tax? Like, how does that work?
That's a good question. So self-employment taxes are a separate style of tax. So that's actually a really good point because it's very possible that I could have lots of itemized deductions that offset everything but my partnership or my single member LLC income, but I still somehow owe taxes. Self-employment taxes are assessed on company earnings, except for S corporations, but it's assessed on LLCs and partnerships. And that is essentially, think about if you're a W-2 employee, it's FICA taxes. So I myself pay my half of FICA taxes. I pay Social Security, Medicare. It comes out of my check. I never actually see that money. It goes straight to the government. Hawk Cruising Associates also pays a secondary tax, which is the exact same amount that I pay as my employer. If I am my own employer, which I would be in the case of a partnership or a single member LLC, I'm going to pay both halves of those taxes. And those self-employment taxes are assessed on company earnings without regard to itemized deductions. So if I give all of my money away to charity, it's not a way to avoid self-employment taxes. And if you're thinking, well, I'll give it away through my company, I'll outsmart the IRS. You deduct those charity deductions on your Schedule A, which is your itemized deductions regardless. You don't deduct them on your business tax return ever. It always flows through the personal return. So just because you give the money away out of the company does not mean that you'll avoid the self-employment taxes.
So does that, like, would that mean that it would be correct to say you are paying like a higher tax if you own a business? Like when people look at their returns and say, it looks like I'm paying more. So are we in fact saying they are paying more?
Yes.
Okay.
You as an individual are paying more. Hawk Cruising as a company, you can kind of think they're paying that tax, and you as a company are paying the tax. So yes, as your own earner and think of your own income, yes, you're going to end up paying more taxes. The benefit that you get is you're able to write things off, which you aren't necessarily able to do as a W-2 employee. But yeah, absolutely, you are assessed an additional style of tax. Accrual versus cash accounting. Once again, we kind of went over that example of if I have lots of receivables at the end of the year, and I'm an accrual basis taxpayer. That means I'm going to declare all that income before I actually receive it. So I'm not going to have that cash, but it's still very possible that I'll be paying the taxes on that. So that's another scenario where I owe money, but I don't really have the money. How is this possible? And if that's happening, maybe being an accrual basis taxpayer isn't best for you in that scenario. And then how do we avoid these types of things? How do we combat this? Because I owe all these taxes throughout the year and I'm no longer a W-2 employee. You pay them on a quarterly basis. They're called quarterly estimated tax payments. So in April, June, September, and then either December or January, depending on your preference, you're going to pay the IRS and the state, depending on the state you live in, directly. You're not going to pay them through withholding like you normally would. You'll simply write a check or have them ACH the money out of your account on a quarterly basis. In terms of how do you go about calculating those estimates, everyone is so different in terms of what they prefer. Some people want to be overpaid versus underpaid versus paid in exactly. Some people just want to pay what's called safe harbor, which is based off prior years. So it's really just a conversation with your accountant. It's not that it's a fairly straightforward concept once you actually start doing it. I'll say it's kind of hard to grasp, I think, before you actually get into it. Catherine, anything else on this slide? Nick, before we move on?
What about, so how does Hot Cruzy, like, can you talk a little bit about Hot Cruzy's estimated tax process? Do we do these for clients? Like, how does that work?
What a great question, Catherine. Yes, we do. So I do them on behalf of business owners as well as standard wage earners as well, whenever they have different styles of investments. In terms of what you will be doing, think of yourself whenever you're a small business owner, you'll be submitting to me your profit and loss for the year, as well as we'll have a conversation normally about your projections for the rest of the year. So let's say, for example, that you have made $50,000 in the first quarter and you say, Jordan, I lost every customer and I have these bills that I'm going to have to pay and I know I'm not going to make any money. Well, I probably won't have you pay in estimates as if you're going to make $200,000 just because annualizing it out doesn't necessarily make sense in that case. So it's more complicated than just take this number, assume it's going to be this for the rest of the year. It's normally a conversation with each other to figure out what your situation's looking like so that we can adjust those estimates as time goes on.
Jordan, I know you mentioned the different quarters for the estimated tax payments, but can you touch on extensions and making an extension payment and what that and how that affects the schedule?
That is a good question. So let's say that I've gone throughout the entire year and I paid in $40,000 to the IRS. And you talk to me and you give me most of your tax documents, but we're going to extend you. And I say, Nick, it looks like you're actually going to owe another $10,000 to the IRS. What I will do is I'll have you pay an extension payment, which allows you to extend your tax return, allows you to get paid into the IRS because you need to have your balance paid by April 15th. And then we'll file your return after the fact. I'll also normally tack on a quarterly estimate into that extension payment. So let's say that Nick is going to owe a total of $20,000 throughout the next year, and then he also owes currently $10,000 for the prior year. I'll have him pay a total of $15,000 as an extension payment that's meant to cover a first quarter estimate and is balanced due at the end of last year. And that is by far the most difficult concept for people to grasp, just because I do it every day and I do it lots of times a day. So I'm kind of used to it, but it is a little bit of a difficult concept to get your head around. I think of paying this extension payment to also cover estimates and how that interacts with your tax return you file later. A couple myths about extending. Number one, it does not make you a more heavily auditable client. In fact, it takes you out of the most heavily audited period. Whenever you think of what is the IRS going to be looking for, they're going to be looking for people trying to jam their tax returns in before April 15th with bad information in them. What are they not going to be looking for? Someone who's taken their time to put their information together and file a good return. That doesn't mean just because you're filing on April 10th that you're doing something wrong in the eyes of the IRS if you have a good information, but that's more likely that you're in that higher selection period if that makes sense. But that's also because there's more bad returns being submitted at that time. Anything else on extensions, quarterly estimates?
It doesn't look like we have any other questions right now.
Okay. Well, I want to thank everyone for joining us for the last 4 weeks. This has been our Business 101 series. If you loved this webinar, want to share it with someone else, want to watch it again for yourself, want to show it for a date night, anything like that, you can find it on YouTube. If you have any questions about it, these are our emails on the slide, and then you see our office number there. And then feel free to set up an appointment. We're always happy to discuss kind of your potential problems, opportunities, solutions, anything. So feel free to contact us at all times. Thank you all.